Concerns about lead remediation have been sending AT&T stock lower recently, with some analysts saying that the cost for cleanup is going to be in the range of $1 to $10 billion. However, AT&T has the free cash flow to cover those expenses. With the cost estimates recently revised lower, it's possible the toxic cable sell-off has found a floor. At least Ray Dalio thinks the floor is in. Let's get into this article before we get into the analysis. And this article is coming from Finbold. Ray Dalio bought this dividend stock. Ray Dalio's Bridgewater Associates is the largest hedge fund in the world with over $123 billion in assets under management. Recently, the fund revealed to the U.S. SEC which companies it bought and which it sold. For example, Bridgewater sold shares of Netflix, Broadcom, and Home Depot, but it did buy this a dividend stock. AT&T is a holding company that provides telecommunication and technology services worldwide via its subsidiaries. Bridgewater Associates bought 1.98 million shares of AT&T at an average price of $15.09. We'll have to remember that level. The total investment is worth about $31 million, and he puts it among the smaller holdings of roughly 0.2% of the fund's portfolio. Investing in AT&T comes with some of its perks, a massive dividend at 7.87% annually, which makes it a great addition to anyone who wants passive income on their portfolio. AT&T recently reported its Q2 earnings, where it beat estimates for free cash flow. That's good. The company said it has achieved its $6 billion cost-cutting goal ahead of schedule and was now targeting another $2 billion plus over the next 3 years. To support the high dividend and service its debt, the company needs free cash flow and cost-cutting measures. However, AT&T is expected to produce $17 billion in free cash flow each year for the next 3 years, according to the Wall Street estimates, which should put the company in a good position to keep the high dividend yield in the coming years. So there was concern that the drop in price would put the dividend in jeopardy of at least being cut, if not ended, depending on the cost of the lead cleanup. But the firm estimates have come out, and with AT&T's free cash flow over the next couple of years, the dividend should be safe, making AT&T no longer a value trap. All right, so he bought at 15.9. Let's get into the article's technical analysis and see if that matches up with mine. Near-term support is at $14. The stock is oversold, rightfully so. If price breaks $15 and manages to hold there, we should see a slow grind back to 18 in the coming months. Okay. Now let's go to the stock chart. We're going to look at the monthly chart, and this is the leg down, the last leg down. The unfortunate part is that we had a close. Well, not yet. So this pivot low is roughly the equal low of the closing candle in July. If we get a close below the 1450, we could look to retest the previous low from the previous month. On a smaller chart, that would look like a double bottom, which is potentially a reversal bullish pattern. Now, the article said $15 as support. It was support until July, when the candle closed below the $15 level. If I squeeze the chart up, there were buyers here several times. However, the recent sell-off could not hold off the buyers. Sellers are in control at the moment. Big picture, though, price has respected this monthly downtrend line. Origins going back to 2019. All right, we're going to go down to the smaller charts, and I will explain the white dash lines and the green dash lines. This is the weekly chart, and this was the week, I guess we had the sell-off. Definitely oversold. You found buyers step in. However, it's been a slow grind lower. Had trend line break there to take it short, but I would not have based on, again, this most recent pivot low. Needed to see closes below it before continuing to short the stock, but ideally I would not have shorted. Ideally you want to look for places to go long. Now these green dash lines, these are targets once price does reverse, if it does reverse. These are Wall Street targets at $16, $17, and then $20. However, the momentum is still to the downside, as evidenced by the 13 and 26 simple weekly moving average. So Ray Dalio got long at 1590, which is right about at this level here. So he's down on his position about 8%. Now this is a level where the chart suggests to go long, near the $12 level. For that, we need to scroll back out to the monthly chart. This area was once all-time highs. Got to go back to 1990. And that resistance became support in 1992. So the chart suggests to go long if price can come down another $2. So I'm going to put an alert at $13, because that would be a place that I would want to go long. I think Ray got in a bit too early, but he's not trading the stock, right? This is a longer term position. There is a reason why his company holds $123 billion in assets under management. So let's see if price can continue to move down. I think there's still some downward risk, but look for bounces in this $12 range, which will end up being a reversal on smaller time charts. Thanks for watching. Subscribe. Please like the video.